transfer the know-how, to everyone around us. So again, thank you very much for attending. Your attendance encouraged me to continue the work and continue the analysis of our markets. I'm going to start first kind of high-level macro, touch on that. Then I go macro tech AI, and then I dive in specifically on some of the things that are happening in my world. Of course, I'm going to talk about DeepSeek and our observation around that and kind of share that with everyone. And then I'll talk a little bit about our research coverage and what we cover. Just bear with me for another minute or two, make sure I give a chance for everyone to jump in. There's some fun facts in the beginning of the presentation that I want to make sure people don't miss. So I'm going to wait for a couple of minutes. So bear with me, and I'm going to start shortly. Still people coming in. Let me get started with sharing my presentation. And let me go full screen here. All right. So I started, sharing these thoughts, I don't know, maybe a couple of quarters ago. People come to our offices and many of our investors, and they want to get a sense of the lay of the land here. What are we seeing? What are our observations? And I thought the best thing I can do is to pull all of these thoughts together in a series of events like this to kind of bring everybody up to speed in terms of what we are reading, what are we researching, what is getting our attention, and an opportunity to share this with everyone. So let me get started. I'm going to start the high level, and as I said, I go from the top and go down to what we see on the ground here in Silicon Valley. That's where we're based at. Just 30 seconds on our mandate. I mean, we are a technology investor. We are early stage technology investor. We invest in frontier technologies in the enterprise. We are not a consumer investor. And we love, supporting and backing the second-hand entrepreneurs, the people who have built businesses in the past with them, experienced teams who are living large businesses with insights, what we call them the net new, where they've taken these insights from where they are or what they're experiencing, and they're building businesses around it. So we are, in a sense, business builders, and our focus are building these businesses in the US, and our focus are primarily focused around the enterprise technology, where these technologies are enabler for large companies as well as for the government. And we have an intimate view and understanding of the need of large businesses and the trends within the large businesses and the government. Let me jump in. So the view from the top. So this is an astonishing number. I keep tracking this number, looking at the U.S. economy relative to the rest of the G7, and how U.S. economy has performed and accelerated its growth over the past years, I would say the past decade or so, and how it's performing. And listening to the current administration and the kind of our new leadership, they're hoping to further accelerate our economy from 29 trillion, from kind of subdued, I would say 2% grower, to anywhere closer to north of, I would say their objective is to get it to north of 4%, which is quite ambitious. But that means the US economy can put up about $1 trillion in growth if they hit a 4%, 3.5% to 4% mark on an annualized basis. And this is a massive economy. And if you look at the size of our population, which is less than 400 million, 350 million people, the productivity of this country and the productivity of our our crew, our team here is producing the kind of economy that we produce is quite significant. And And we will see. We'll see what's going to happen by the new administration coming in and looking to accelerate the growth of our economy across many different sectors. The second data point, and this is something that we highlighted in our last call, our viewpoint was that the interest rate is gonna remain stubborn, and the inflation is gonna stay stubborn. And the reason is we had two facts. One is the fact that the deficit of our government is continuing to grow. And I just read that over the past 4 months, we have 700 billion deficit, which is incredible. And of course, as the government has a significant deficit, the demand on that, the interest rate that we have to offer is significant to satisfy the demand that we have with respect to our deficit. And high interest rates is actually inflationary. So it's sort of like it's a no-win situation. You have the high deficit and you have high interest rates, and it feed each other. And the translation is that you're gonna have inflationary forces, in the economy, and that's why we are seeing this stubbornness with respect to the interest rate and what the expectations are in terms of what the rates are going to look like. So I think we put that in perspective, and we want to make sure that we keep track of the big picture of where we are with our economy in the United States, where the interest rate is going to look like, and where the focus is going to be. Now, again, drilling down one level lower and looking at the S&P 500 performance, which has been incredible. And then you start dissecting it, and this has been something we've highlighted in the past. If you take the Max 7 out of the S&P 500, you get to see a very, very different picture in terms of the performance of the market. And you can see the contribution of the Max 7, and you can look at the share of the returns of Max 7 relative to the S&P 500, and you start asking the question of, this is a pretty traded, heavily traffic trade, and the concentration of these trades is alarmingly high. So there's supply and demand, and the demand is very high on the Max 7, and the supply is extremely, extremely limited. Especially with Max 7 are some of the largest, they have some of the largest buybacks in the market. So it feeds, each other, and you can see the performance of the S&P 500 net of the Max 7, and then you raise your eyebrows in terms of the overall performance of the market. We are trading at all-time high or nearly all-time high. And the couple of other things we track is we're looking at the percentage of unprofitable companies essentially in the current market, and you can see it's quite high. And that takes me to a conclusion that lack of IPO and shrinking of the public market and the concentration of the market around the very specific set of names, it's alarming. So the public market, I don't know how long this will go, but either we need more inventory of names so people can get into it, and this IPO market at some point is going to break and is going to open up. That's the hope of a lot of the people like myself who are in the private markets. And the shift of capital from this concentrated set of names and broadening the market, and when is that going to happen? And we are looking at 2025 and 2026 would be the time where you're going to see the broadening of the market beyond those very concentrated names of 7 in all of our portfolios, and specifically in the S&P 500. So this has been going on for a long time. We have not seen this kind of a IPO market for a long time. I mean, you can look at from the chart is from 2015 till now, and you can see this is all-time low in terms of the number of new names being issued in the public market and that's a problem. And this is also give you another lens, viewpoint is that there are only 4,300 names in the public market, and it's capturing 90% of the total capital, versus we have just under 60,000 private companies in the United States, where they're only essentially 10% of the capital is chasing it. So where is the opportunity? It's just I look at this stuff purely as supply and demand. I think the supply in the public market very limited at scale businesses, with of course extremely healthy fundamentals, what uh, lower growth rates. And then on the private market, you see a top of the funnel to be very large, and the possibilities of being able to buy at better prices and being able to have a broader sort of exposure is there. And so that's why we do what we do. We think that the private market has significantly better risk reward relative to the public market. And we think that we have a very good set of names to go after and build excellent portfolio of growth companies and deploy capital against it. So this is again quite an interesting chart that this kind of divergence has grown significantly from 2014. Is literally, look at it, 25,000 private companies to 60,000, just under 60,000 private companies, while the public market has been relatively flat over the same period. Here's a case for seeing a renewed IPO market. I mean, Reddit raised capital in February of 2021 at the period where the interest rates were at the low points, and they raised more money, and you can see the valuation expansion from February of 2021 to August of 2021, and then subsequently they went public lower than their Series F valuation. By the way, the people who bought shares in Series F, they had ratchets, so they were protected on the downside. And they went public at 6.4 billion, and today the market cap of Reddit is sitting as roughly around 37 billion. I'm not suggesting you should buy the stock, or I'm not have any opinion around the valuation of this company. I'm just simply trying to share a case, and we are seeing this case in many places where there were people who have had the courage to take their company public, and we do encourage a lot of entrepreneurs to have similar courage as the CEO and the founders of Reddit, where they took the business, and the board of Reddit to take the company public. We do encourage the same behavior, where you got to go out there and you bite the bullet. If you have raised money at some prices in 2020, 2021, you got to have the courage to be able to reprice it and then get on with it, and take the capital into your balance sheet and focus on building your business. And over a long period of time, everything would be normalized to the performance of the business and the fundamentals of the business, as the case with Reddit. So a couple of important facts. The public market, the inventory in the public market, limited. The inventory in the private market has grown substantially. There's a lot of capital chasing the same names in the public market. There are less capital available in the private market, and hence the idea is to take a deeper dive at the better look of the private market and looking at the opportunities that's around it. There's a lot of great companies with great fundamentals, with great growth potential that are private. One other interesting fact, because of the conditions that we experienced in 2020, 2021, it's also the fact that the people do not want to raise capital, because they raised capital at very attractive prices in 2020, 2021. They have now shifted over raising capital using venture debt. And that you can see the rise of the venture debt since 23 and 22 is at all-time high. And a lot of the growth companies are tapping into the debt market to finance their growth rather than trying to go out there and raise capital because of the fact that they're not willing to take a hit on their equity prices because they raised money at very, very too good of attractive prices, and they're not willing to acknowledge the fact that that was an anomaly and hence the growth of the venture. So again, I'm building the case that the companies who are reached to a level of growth, they have to bite the bullet and live with the reality that the prices of 2021 might not come back, and you want to be able to focus on the fundamentals of the business and the growth of the business, and of course, having access to the capital to continue their growth and building their businesses. And hence, we think that a period is going to be ahead of us where you're going to have more of a Reddit case than before. Switching topic. I'm going to spend some time talking about DeepSeek and the implications and the condition, the new condition that's present in our sector, and the implication of DeepSeek. This is a history of DeepSeek. Of May of 2023, they founded Liang founded DeepSeek, and in November of 2023, they released the version 1 of their large language model, and they continue the progression of releasing that in May of 2024, December of 2024, and then there it was. Then all of a sudden in January, and then subsequently in January 27, there were multiple releases, and that release of R1 really shook the world. I'll just pause here for a minute. And I remember in 1995, post Netscape IPO, the rise of internet, the early days of search, the early days of number of companies who were participating in the search market, and there were quite a few of them. And I recall that if you look at Yahoo as an example, was the dominant destination for search, and Alta Vista, and many, 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 many more companies were participating in this very broad market. And then the market started to consolidate, and the consumers started to gravitate, and the business started to gravitate to a fewer at-scale player. And then all of a sudden, there was this small player showed up called Google, who was actually the last player who entered the search market. And here we are. And today, search dominated by Google. I don't know, somewhere probably about 80% of the total, 90% of the total search market is dominated by Google. And the Google was not an early and was not an early lead into those market. It was a late entrance to the market with a completely different sets of approach and technologies to address the search market. So I see the same thing where people have asked us, what are you guys chasing on early LLM? And the answer to them was that, look, they're going to be in this period where the architecture and the approach is not settled. And I've cited this very case of my own experience in the early days of search, and how the architecture of search and the approach to search changed over a period from essentially 1995 till 2005, 2006, when Google dominated essentially the search. The DeepSeek and their approach was clever. They outflanked many people. Let's just say that. Let's acknowledge that they outflanked. And how they outflanked and how they achieve what they achieved is to be discussed. There are controversy around their achievement, and we'll touch on that a little bit. But you look at this timeline of, whoa, in 2 years, I mean, they achieved a lot. And they don't have access to the advanced H800 of NVIDIA. What's going on here? Why is it a company less than 2 years old, started by a hedge fund, quantitative hedge fund innovator that was managing essentially a hedge fund, being able to produce an open source, a piece of technology has taken everybody by surprise. What's going on here? The claim was that they were able to deliver DeepSeek V3 with roughly $5.8 million. Versus when you look at the cost for training GPT-4 was around $100 million. And then you look at the benchmark of the two LLMs across the benchmark tests, which is looking at the LLMs that produce code or LLMs that do complex maths and a number of other areas. And you can see that the LLM, the DeepSeek LLM, outperforms number of other essentially models at a lower cost and with proficiency and accuracy of some of the best trained LLMs. How did they do it? And what's the implication of it? And it is open sourced. That means there was a step function of availability of that technology to everyone. That was a step function. The release of the DeepSeek stack as an open source model is a big event in our industry. That means the parity that this LLM has produced is significantly changed the landscape on a going forward basis. And interesting enough, the biggest backer of OpenAI, Microsoft, was one of the very first adopter of DeepSeek LLM and immediately introduce that open source model on their cloud. And it was an important event where people started realizing that there is a lot more here than people recognize. So it wasn't just a fact that it was an open source. Then when you look deeper into their architecture and their approach, and these are sort of technical jargons that I'm sharing with you, there were 4 elements to their approach, which essentially was superior to the LLMs that were out there, which was, by the way, they were not open source, with the exception of the Meta offering. Everybody else is a closed source. And here we are, and they had a very different technical approach to their LLM, and this technical approach has yielded a significant result. And these are the 4 elements, the mixture of what we call expert model, we call it multi-head latent attention, multi-token prediction, and one of our colleague Anthony put this together, and the fact that they're using 8-bit versus 32-bit floating point numbers, that's completely, were new and a completely new approach. It's kind of reminds me of Google showing up into the party kind of a bit late with a very different approach with a superior model. Have I seen this movie before? Yes, I have. And hence, the question is, what is happening with all of that capital had gone into developing of the LLMs, and whether the LLMs that were closed LLMs would be able to survive versus the open source. So we were a believer for a longest time that the open source is going to win, and the closed source models don't have the benefit of the collective conscious and the collective talent and the collective participant. And hence, we were a big believer that our companies and the companies that we invested in should not be built their technologies on closed source systems. They need to be adopting open source system, and to be able to plug and play as new LLM arrives, we should be able to adopt them rapidly into our infrastructure, and hence they are more flexible and not tied into a particular or one particular LLM. There was a significant price correction along the way. This chart is an interesting chart that shows you, the ChatGPT versus the DeepSeek and the cost per 1 million token, which is an important indicator. Tokens are essentially is the number of call it words or number of specific tokens that gets used to build a model, and you can see the cost per 1 million token has significantly have gone down. They have used multiple tricks to be able to achieve this price. Whatever there is, it's a big deal that you can now have reached a level of maturity of the current LLM that on an ongoing basis, the cost of training that model is relatively lower than the other model that is out there, including Llama 3.0, which is offered, is an open source by Meta. So the race is on. And is there yet another DeepSeek out there that's going to show up? We don't know. But there is no question that in our mind, that if you look at the top two players are open source players. And hence I argue that, and I argue with our founders and our companies, that fundamentally it's a better risk reward to stay with the open source model. And we would let the application people go use some of these closed system, but we as software publishers, we need to build our infrastructure and architecture on open source. And one other interesting fact, we said, well, then what's the cause and effect of this lower cost? What's the implication in terms of the computing needs on an ongoing basis? Does it actually going to reduce? The LLM needs less compute, but the application of AI and the broadening of the AI is actually going to accelerate. So if you think about it, is that electricity, and we were looking at the history, I was looking at the history of electricity in the beginning of the availability of the electricity, and it was super expensive. And here we are; it's widely available, and the need for the electricity and it's only have grown. So I do not believe that necessarily this step function of the reduction of the cost of a training of a DeepSeek LLM model was going to result on less capital expenditure or data centers around AI. Is actually empowering the broadening and empowering of the consumption and the development of the AI across many, many industries. Since the announcement, and we've listening very carefully of all of the hyperscalers and their projected annual expenditure in CapEx, and everybody has come up, even after the Stargate announcement by Oracle and OpenAI and SoftBank with the president, that's not going to slow down. And the development of the data centers and the development of the CapEx around this area of around AI infrastructure is not going to slow down. We think actually a DeepSeek, it was a step function in terms of the innovation, so that it's going to accelerate the development of the AI and the adoption of the AI on a very, very broad basis. Here's a fun fact. The world has 11,800 data centers. Neil put this slide together for me. At 46% of those data centers are in the United States. This is the core infrastructure. This is no different. Do you have electric, you have power, or do you have energy, or do you have, this is infrastructure. And it's very important for the competitiveness of our economy, that we continue developing this infrastructure and all of the supporting actors, including energy, that's going to that power up these data centers. This was a fun fact that 46% of the data centers in the world reside in United States. Some other fun facts, and again, as I read through a lot of this material and try to capture some of these thoughts, is that we think that the global infrastructure investment, including alternative energy, in particular energy, is going to accelerate, and it's going to require to get to the. If you take the chart of the demand and correlates the infrastructure investment, you're looking at 3.5 trillion annually needed to continue the development and investments required to support the infrastructure, the technology infrastructure built out that's ahead of us. And 700 billion would be the annualized expenditure by 2030. This actually came from BlackRock, who is a massive kind of investor in the infrastructure sector. And we're looking at their data. And the roughly 2% of the total GDP of the United States would be invested in infrastructure to supporting AI. AI is fundamental to the competitiveness of any economy. AI is fundamental to the competitiveness of any economy. When you cannot compete as an economy, you cannot produce at a lower cost to be able to essentially increase the standard of living of your citizen without this level of investment. Those are required now. And we, as a country of 300, just not, let's call it under 400 million people, producing 25% of the GDP of the world, we just don't have enough people to be able to keep up with a 3 to 4% GDP growth. And hence, the only tool that's available to us, is the technology. And technology is what's going to enhance us as a nation to compete, as a nation to be able to increase the standard of living of our people while continuously thinking about how we're going to be able to accommodate the growth and increase the standard of living. And that's the game we are in. The other thing that was also interesting is that the private market is going to continue to grow for a variety of reasons. I mean, the regulatory regime that came in and changed the public market, I think, had a very long-term effect. With respect to the companies going public, the private market is going to be the most interesting place to create wealth. I believe that. That's what I tell my children, is that you got to be able to deploy your capital in places where it's not easy to get access to, or you don't have the knowledge to be able to analyze it and understand it. And the world of the public market is going to be a crowded place to show up, and you got to go, well, the knowledge is scarce, access requires significant amount of know-how, and you got to have the selection capability and support that these businesses need. And hence, I think that the private market is going to continue to grow significantly, and that's where the juice is, that's where the upside is to be able to deploy capital in. Another fun fact is that 78% of the software engineers are now using AI. We can produce more software with fewer people, and this number has grown year over year, doubled, essentially. It's 40% to 78% in 1 year. And that's a really a big deal. And then last but not least is I can't talk about the energy and the need for energy and the consumption of the energy and the power in particular, because of the data centers, is going to be a massive hit in terms of, or massive opportunity for people who are in the independent side of producing energy. And the other day, I found out that one of the largest investors in the alternative energy is it's Exxon, and it's Chevron, which I was really excited and happy to hear that there is a massive shift by even Aramco in Saudi Arabia and many other ones that are shifting as energy providers to the global markets, that they're shifting our efforts into the alternative energy and building massive energy plants that are alternative energies. So we have this condition where AI has arrived, early innings, significant promise, rate of innovation, incredible rate of innovation. It surpassed, and I will show you some more facts later on. It's gone through a step function after step function in terms of what it has been able to accomplish. Well, how do you play that? If you don't invest in it or you invest in it, and this is a chart again, Neil cleverly put it together. Either you believe AI is profound or you believe AI is overblown. And two scenarios. Are you a believer or you're not? Let's assume that you are not a believer, and you go in there and I said believer is, let's say, overblown, and you put a significant amount of you don't want to put a significant amount of your capex in it, and business as usual. So your gain would be muted. You're not playing, you're not investing in it. There's no capex expending by you, and if you are right, and it's overblown, and you didn't put any money in it, you're okay. Now that's the kind of the lower left-hand corner, and if you do invest in it to some extent, the worst thing you have done is you have invest a bunch of capex, and you probably recover it. There's not much to it. But if AI is profound and is in a step function, and you don't invest in it as a business, you could be outflanked, just like many, many other S&P 500, I should say past S&P 500 companies who didn't realize there is a change. And they missed the change. And they became seers because they didn't realize Amazon arrived. Or they missed these fundamental changes and they did not invest appropriately. You could get wiped out because of the technology shift and change. Maybe it would be a slow wiped out, but it would be it would be painful. The best place to be, and I think that's where, if I get a call from the CIO of any of a large S&P 500 and says, Bobby, and I have a lot of friends who are running big infrastructure for big companies in the US for the government. And I am a believer that there is no way avoiding AI, and you need to be investing in it. And that's going to yield significant return long term. Now, the pace of it depends on your business. The pace of it is depend whether you can accumulate enough knowledge and know-how. The pace of it is related to how you be able to add value to your customers and to your market adopting AI. But there is no avoiding at this point. There is no avoiding, and I believe that the investment in AI is going to continue. I mean, there is this summer I was talking to Rich Ellinger, our CTO, and we're going to have tons of interns here that's going to be enabling us changing our business and adopting AI as a core capability of Cota. We would be an example of a business that's not willing to avoid this, and we are going to adopt it and change the way we do things, leveraging AI capabilities. We should be able to do our work better and serving our partners better, serving our investors better by adopting this technology. And we are going to do that. And I'm hoping that as we unfold a lot of these things, we will be able to share them with you. Here's another fun fact. Waymo is eating Lyft's SF market share. I mean, there is not a day that I don't see 5, 10 Waymo cars, as I come to my office or go back to my home, and the rate of the adoption and the safety of this technology in San Francisco. And I was happy to tell a friend of mine was at Phoenix just a week or so ago, and he was surprised the number of Waymo cars around the Phoenix airport. And LA is the next, and it's going through a step function in terms of maturity. And it's incredible the quality, and it's incredible, yes, on a benchmark basis, it's safer than the other alternative. And that is now, at least for the limited experience we've had, the numbers demonstrate that Waymo cars are safe. It's limited. I have no doubt, and I hope that there wouldn't be an event out there that someone gets injured or impacts anyone. But on a relative basis, the experiment has yielded that the Waymo and the Waymo technology is safe. And the unit economics is only going to improve, and the number of vehicles are going to increase, and the quality of those vehicles are going to improve. And it's expanding. It's expanding. And just about 2 weeks ago, I was in one of them. We were, with a friend of mine, we got in the back of the car, and it was an evening, and from time to time, I'm in one of these vehicles, and I can see the step function change of the technology and how smooth of a ride I had going from one location to another location. One other fun fact, again, we looked at, this is the good old Moore's law that started 40 years ago when Intel introduced the cost decline or the efficiency of the technology that Intel was bringing to the customers over a period of time. And you can see it that from battery to genome sequencing to solar farms to cost per mile range and compute, they are deflationary. Technology is deflationary. Adoption of the technology at scales is deflationary, and productivity for the society. And we are a big believer that adoption of the technology at scale is only going to increase the standard of living and is going to increase the quality of the life. Yes, everything has a baggage. There is a good and bad in every baggage. But overall, it's deflationary, and it's going to be constructive for the society adoption of the technologies at scale. I'm going to finish up with our kind of narrow, again, our world is very focused on enterprise software. Our market is robust. Adoption of the technology with large enterprises are robust. And the other day, Elon was at the president's office talking about, kind of talking about technology and the lack of adoption or digitalization of the government, and many opportunities that's available to the administration to improve the kind of the cost effectiveness of the government. The cost of our government could substantially change by broadening the adoption of the technologies across multiple different areas. There are rational, actually, arguments that there's still a lot of human intense cost and work involving the government, and how technology can help and improve not only the cost structure of the government, but also the service that the government provides to the citizens. And from that to many industries that they're still in the early innings of digitalizing their business processes or transforming their businesses to digital businesses, tons of opportunities. And within this kind of transformation and the shift, there is a lot of net new opportunities that are arriving from cybersecurity on one end to acceleration of the supply chain, building digital twins of businesses so that you have better visibility and better hand around your activities and business. Tons of opportunities constantly being surfaced and become available for companies, entrepreneurs, investors to be able to participate. It's robust. The enterprise technology businesses have come back since 22, 23. The multiples have come up nicely as we see it. Still, the market favors the infamous Rule of 40, grow your top line and grow your margin expansion and cash flow expansion. You get, if you can show that kind of correlation, as you grow your top line, you can accelerate your bottom line, and the correlation of those two, because you're a high gross margin business, you get treated really, really well. And if you can do it, north of 40, which is the combination of the top line growth and the bottom line, I should say, growth, you get treated well, and you get a premium over that. Here is just a quick slide on our research. We have a very good research team and a research coverage across different areas of the enterprise. This is our superpower, is to study a lot, talk to a lot of great entrepreneurs, learn a lot from those entrepreneurs, debate internally intensely around a lot of these topics, try to connect the dots, trying to see the open spaces, trying to find those special people with special insights, know-how, deep knowledge, that they have the motivation and they have robust characters to be able to take on and be an entrepreneur. And we love what we do. We love supporting our companies. We love supporting people with the spirit of entrepreneurs, that they want to build things, that they want to change things, and they have identified gaps. And our research team and our partnership is continuously in search of those very special people and opportunities. There is a lot of content our team have published over time that are on research work. I encourage you to visit Cota Capital, Knowledge Capital section of the website. There's tons of good material that our team constantly are publishing. I think being a good student can make you a good teacher. Teaching and transferring knowledge makes your work better and force you to think clearly about things. I mean, this is a practice that we have here at Cota. We like to be in a position to be a good teacher, and being a good teacher makes us master in the work we do. And we think we want to continue that tradition, to constantly trying to offer the knowledge we are accumulating to our partners. This is my last slide. I want to thank you for the time you invested with me this morning. Again, I'm looking forward to the next session, and I'm going to try between the next time I'm on one of these calls, try to accumulate as much knowledge as I can, humanly I can, and try to put them all together for you and share them with you. And with that, I want to again thank you for participating today. Thank you very much.